Hi, I'm Chris Wright, president of Wright Wealth Management Group. I've received a lot of questions in the past few months about how an investor can try to avoid Social Security taxes. A lot of investors are not aware that Social Security originally was not intended to be taxed back in 1935 when Franklin Roosevelt implemented the Social Security tax system. Actually, Social Security income was not taxable at all until 1983. And then again, the threshold limits were changed also in 1993, making the potential for Social Security income to be countable up to 85% as ordinary income. A lot of investors are not aware that there's a special equation used to determine whether their Social Security income is taxable or not. This is defined as the provisional income tax equation as it is associated with Social Security income. What provisional income basically states is that as an individual takes all of their different types of income that they receive from bank accounts, CDs, investments, brokerage accounts, pensions, ordinary income, distributions from their IRAs, whether they have an RMD or not, if they're taking a withdrawal from a IRA or 401k after the age of 59 and a half, those withdrawals are reported as ordinary income. Also rental income. If an investor has rental properties, that rental income is also countable in the provisional income. And even the double whammy that we often hear so often about are investments that we were supposedly told were non-taxable, such as double exempt municipal bonds. The interest that they spin off each year is countable for the provisional income tax equation. So after we take all of this income and add it up within the provisional income equation, the IRS also makes us count 50% of our total household income from Social Security and add that 50% of the Social Security income we've received on top of our additional income within that provisional income equation to determine at what point or how much of our Social Security income is countable. For instance, if our total provisional income is no more than $32,000, none of our Social Security income would therefore be taxable. If our provisional income is between $32,000 and $44,000, up to 50% of our total Social Security income is countable as ordinary income. And then if our total provisional income is over $44,000, up to 85% of our Social Security income is now countable on the front page of our tax return as ordinary income. $44,000 of provisional income is not a lot of income if you really dive into how that is calculated. I mentioned it earlier, but I'll go back to it. Let's say that we have total income, not including Social Security or half of Social Security, of $30,000 a year. We maybe have a pension of $2,500 a month. That would be $30,000 a year. But let's say we also have $30,000 a year of Social Security income. So if we take within that provisional income equation, half of that Social Security income is countable in the provisional income equation. That $15,000, half of $30,000 of Social Security income, that $15,000 is therefore added to our $30,000 a year ordinary income that we have, putting us at $45,000 of provisional income, making up to 85% of our Social Security income taxed at ordinary income tax rates. So we really have to be careful with the amount of money that, number one, we are keeping in our IRAs and 401ks, because we know that upon distributions and upon RMDs, required minimum distributions, just our required minimum distributions alone may not only be taxable at a higher rate because they'll be added on top of our other income, but our required minimum distributions may also cause our Social Security income to be taxed in that 85% category. We always have to remember with our IRA accounts that we have a partner in those accounts, and that partner is Uncle Sam. And what we mean by that is many investors have large IRAs and 401k accounts. We know that the IRS is a partner in those accounts because as we take distribution, those distributions are taxable. I believe that investors can actually have too much money in IRAs and 401ks, which would expose them to what we call future tax rate risk situations. Think about that for a minute. If an investor had, let's say, $1 million in IRAs and they're around 72 years of age, their required minimum distribution on that $1 million IRA is around $40,000. Well, if they have an annual pension of $40,000 already and they have to take a required minimum distribution of another $40,000, that's going to give them $80,000 of ordinary income, which is automatically going to throw them into Social Security tax problems because of that $44,000 threshold married and filing joint that we talked about earlier. One of the strategies that a lot of investors will use prior to their required minimum distribution ages is to try to do some Roth conversion strategies over time to reduce the amount of money they have in IRAs and 401ks. You see, the government predicts there's somewhere between $16 trillion and $20 trillion in tax-deferred investments such as 401ks, 403bs, 457 plans. And the reason why those accounts cause our Social Security income to be taxable is because we've never been taxed on those funds. Those are pre-tax dollars. They've been growing tax deferred, and we know with those large IRAs and 401k accounts that when we take distributions, those distributions are taxed at ordinary income tax rates, but they're also countable in the Social Security Provisional Income tax equation, thus potentially making our Social Security taxed at even a higher rate. I'm Chris Wright, and thank you for joining us today concerning what is provisional income and what income is countable within the provisional income equation that could potentially make our Social Security income taxable. We look forward to you joining us next time as we discuss other financial matters.